Okay, now we're live. Have a good show.
Thank you. Well, good morning, everyone. It's Monday, March 16th. We made it through the weekend, and here we are Monday morning. Oil prices are down, and the market's up sharply. So, um, oil prices, I'm a little surprised they're down this morning, but the weekend was somewhat uneventful in terms of no further disruption or major escalation in attacks on the Strait of Hormuz. And although for most practical purposes, the strait is still constrained. And there are some tankers making it through, and Trump trying to pull together a coalition of countries to provide safe passage of cargoes through the Strait of Hormuz is providing some hope or relief to oil prices this morning. And at the same time, um, releases from strategic petroleum reserves and other efforts to provide supply, including lifting sanctions on Russian crude oil, which was already out there, but just allows it to flow freely to other places other than China. So that's all given a little bit of hope to oil prices that maybe there's getting to be some control or constraint around the Strait of Hormuz where Iran won't have the ability to block any shipments or continue to provide that element of fear for keeping cargoes from traveling through that strait. And like I said, some cargoes are making it through, which is a good sign. So we're still at around what $95 a barrel here this morning on crude oil prices, and the market's looking forward here, assuming that at some point things do get better. Now, the one thing I want to emphasize is that we're still running a deficit net of everything of around 10 million barrels per day, plus or minus, on a market that supplies or consumes just over 100 million barrels a day. And so that's sort of tipping the balance from, again, we talked about how a year ago or 6 months ago, everybody was forecasting an oversupply of crude oil this year. That's out the window. And that 10 million barrels a day, does that come back? Well, not all of it comes back in the sense that they're not in the US, but maybe in Kuwait and other places. If countries have to turn back the wells and not be able to load that crude oil into tankers or storage or someplace, you effectively lose that for the near term. You can't come back and turn the valve up higher than what it was before. So although you may say, well, yeah, we're running a deficit of 10 million barrels a day, but that oil's out there, and as soon as we open up the strait or decide to let it out of tankers or it's floating on the water someplace, it comes back into the market. That's partially true, but there is some element of some of that crude oil just being locked into storage or underground for the near term. And so when you look at oil prices, December, the contract's at around $75 a barrel. And I think once we sort of make it through this, whether it's 2 weeks, a month, 3 months, 6 months from now, I think we do get a handle around this situation, and it's not a permanent disruption or blockage or anything that for the long term keeps oil flowing through the Strait of Hormuz. So given everything, when we look out further, I think that 70 to $75 a barrel is probably the longer term being out 6 months to a year, the normal price. We're no longer going to be in the $60 to $65 per barrel range that the market was sort of baking in to the valuations and such. I think it's going to be more now in that $70 to $75 per barrel range. And again, the December futures contract for WTI is at around almost $75 a barrel. So clearly, everybody knows estimates have to come up for the oil and gas companies. The stocks have already moved up sharply, but net, I'm not selling anything here. I'm holding on to all the positions. I still like the valuations, even though it's interesting. Even though oil's off more than 5% this morning, the oil and gas stocks aren't off sharply, and some of them are even up this morning. Looking here again, you've got CNQ, Expand, EQT, Devon, EOG, Chevron. They're all up slightly this morning. So the market's not getting, concerned about oil being off 5%. I think the market understands that there's been a lot of value creation here already with the realization of these higher oil prices in the 2 weeks that this has been ongoing, and that their estimates have to come up just given where the oil price is likely to be versus what expectations were before on a long-term basis, at least through this year, perhaps beyond this year in the 2027, given we're not going to have that oversupply situation this year that a lot expected 3 6 months ago. And so, in the meantime, I'm holding on to energy names. I'm not selling anything. I'm not writing any covered calls. I've been asked about that last week. I'm not at the point where I say, yeah, we're going to have a sharp pullback. So let me take in some profit by writing covered calls. I'm not doing that here. I'm just holding on to the names. We'll see what happens. I mean, it's still a situation where anything could happen in a sense that could Iran pull the trigger on mines in the Strait of Hormuz? Could they pull a scorched earth strategy of blowing up their own wells and their own facilities? Remember, Iran was exporting close to 2 million barrels a day before. And once the dust settles, even if Israel and the U.S. pull back, it's going to be probably a disorganized sort of a mess there in the meantime. And if it's not a regime that the allies view as friendly, they could then put sanctions on continued exports from Iran. And Iran, their main source of their economy is their oil exports. So, unless it's a situation that the U.S. and Israel view to be amenable to them, they could, like they've done with Russia, put sanctions on that oil. So it's not certain that when the dust settles, it's going to be a situation where that Iranian oil comes back into the market either. So again, I think the new normal once we get further out is going to be $70 to $75 a barrel. And I think obviously in the meantime, estimates for these companies have to come up, and the valuations, if we value them off of $70 $75 oil, I'm comfortable holding and owning these names here. So again, I'm not selling anything. I'm holding on to my core positions. The one name I'm not adding to, whether it's Cheniere LNG, I didn't quite get to a full market position in that, but I'm not adding to that right here. I'm just waiting and watching on that name. That was the one name we added to last week.
Bob, under your heading of anything can happen, and there are all sorts of scenarios, and with the caveat that neither of us are geopolitical analysts or strategic military analysts. My
Mm-hmm.
question is, we've read about the mobilization of amphibious forces, which implies that there's the potential for boots on the ground. And one of the targets that could be considered is Karg Island.
You're
And so
right.
your comments about a scorched earth strategy, I think, come into play if we start to put boots on the ground. And I don't know if they would destroy the infrastructure on Karg Island, but if they did, how, how long does it take to rebuild something like that? And then sort of folded into that question is there has been some weakness in the Schlumbergers recently, but I mean I assume those would really pick up if they started to destroy infrastructure. So any thoughts around that whole
Yeah, and the infrastructure is probably going to be Schlumberger is more on the oil field service side of it. So the infrastructure side of it is going to be somebody else that have to look in to see who would then rebuild it to be a construction company. But um, if they were to destroy all the terminals and the pipe offloading facilities and storage facilities there, it would take a long time to replace that. I mean, you're talking about 6 to 12 months at least just to put the steel back in place and the piping back in place to resume those exports if all those facilities were totally destroyed. Now, maybe you go further upstream and be able to tie those wells and the pipelines into something quicker that you can offload into a tanker at a separate location and run some pipe real quick to an offloading dock someplace else. I don't know. Maybe it's a little bit quicker, but certainly it's going to be very difficult then for Iran to be exporting closer to 1.8, 2 million barrels a day again in that scenario. And again, that's a scenario if you try to repair it and put it back in place, you have to have a regime that's willing to let the U.S. and whoever else come in to do that, that is acceptable basically to Trump in allowing them to resume their oil production and exports because we say, okay, yeah, you're doing what we want you to do now, and it's a regime that we sort of blessed and we'll let you we help restart your economy. But otherwise, it's still a weapon to use. If it's the old regime in some form still in control, I don't think they're exporting crude oil in any case.
your comment about steel is caught my ear, and I'm trying to remember is Vulcan Materials. I don't. This is way out of my comfort zone. But I wonder, are they a steel producer? I can't
I have to
remember.
go back and look. You
Yeah,
caught me off guard.
yeah, me
Yeah,
too. Sorry,
yeah,
we're out of our element here. But anyway,
yeah.
that's an interesting play. If we have boots on the ground, it's worth thinking about steel.
And look, they're still Iran. They're still shooting missiles at all their neighbors. They're doing things that don't you would think are not smart, but they seem to. They're not looking at this logically. Again, what we said from the beginning, this is sort of a religious war for them, and so it's hard to predict. It's sort of unpredictable what move they may make. I mean, like I said, they could end up turning to a scorched earth policy just to go out with guns blazing. You don't know.
Yeah, right. Do you want me
I'm
to
not.
pick up?
I'm not predicting that, but you can't rule everything out. I mean, you just
Yeah, I
don't know.
mean,
There are things that could happen. You can't. You don't know. You can't predict. I think it's a low probability, but you don't know what they have up their sleeve and what they could do. I mean, they're spread out now. It's not like everything's concentrated in one place that U.S. can target. It's spread out all over the place. It's not easy to find which house the enemy's in, and where this set of missiles are hiding or being stored. It's gotten to the point where you've taken out all the easy stuff. So what's there that you don't know about?
yeah, I mean that's the risk to the markets. Is Trump administration wants this to be a 4 to 6 week war, but he can't universally declare an end because it takes two to tango, and Iran shows no signs of wanting to negotiate. So
Yeah.
um, this could, I mean, that's the risk. This thing gets dragged out if you put boots on the ground, and then there's the potential for a scorched earth strategy from the other side, which you can't control.
Yeah, and I don't see a ceasefire type agreement anytime soon, and so I see no reason to bail or sell or take profit yet on any of the stocks that we own that we like, that we have a nice gain in, that are paying nice dividends, and I'm just sticking with them. And last week I said on at $94 oil, I thought the risk was still skewed to the upside versus the downside. Here today, maybe it's a little bit more balanced, but I would still take the over versus the under.
You stuck, and rightfully so, with some of the bigger names, and have had a great call on those, Bob. But are there, I was thinking of Venezuela and who would want to go down there. Obviously, Chevron, as you've highlighted, is the big play there. But are there any wildcatters? I mean, I'm thinking of a Murphy Oil or a Magnolia Oil and Gas. Who would be willing to go into places like Iran or Venezuela and set up? Are there any others other than the majors?
There are, but it's hard to pinpoint who those names are. And some of our private companies. I mean, Scott Sheffield's son was at the table at the meeting when um, Trump called everybody in and sort of scolded Exxon for um,
Scott?
Scott Sheffield. He was the
Okay.
CEO of Pioneer Natural Resources that sold to Exxon, but his son had a company that they sold to. So, the point is, you've got some young entrepreneurs that are in there saying, "Look, give us a seat at the table. Maybe we can raise money to go down there too." So there are a lot of companies that could venture down there if they're willing to spend the money. And Exxon's the big one that could go in addition to Chevron and some Total and some others. But as far as the smaller independents, nobody's raised their hand that we know of that we would say, okay, here's some upside value that clearly there's good odds that they can end up being operators or drilling in Venezuela. So, I mean, the clear plays are still the Chevrons of the world. And then the
And
service
outside of
companies, the Schlumbergers and Halliburtons.
yeah. Uh, outside of the military conflicts, what is the word on shale drilling? I mean, you had Harold Ham said he was going to stop drilling. Is that still with prices now up? Does that become more attractive?
Well, the economics are better, but the point we made last week is all this windfall profit or cash flow these companies are receiving now, they're giving back to shareholders. Nobody is taking this money and saying, okay, we're going to drill more, we're going to produce more. Everybody's still in this sort of steady state pattern of keeping production basically flat or maybe growing up slightly. But their mantra has still been, especially among the independents, to return anywhere from, say, in EOG, 100% of excess free cash flow to shareholders, to some like Diamondback that are still looking to pay down debt. after paying down debt, still returning 70, 60, 50, 70% of cash flow back to shareholders. So again, this windfall really goes back to shareholders, and it's largely in share buybacks and or maybe a special dividend. We'll see if anybody comes back and pays a special dividend. But again, they're going to give it back to shareholders in the form of, in some cases, paying down debt, but otherwise buying back stock and or maybe a special dividend. But nobody's saying, okay, we're going to take this and we're going to drill more wells. We're going to go out and lease 5 more, 10 more rigs and drill more wells. That's not going to be the case. But as far as shale drilling, yeah, the economics are better. It's still going strong. The results we just saw in the third quarter, companies continue to do better and better as far as the drilling efficiency and the performance in drilling these shale wells. So that's still going strong. You're just getting a lot better returns today than you were getting before from what you already planned to drill.
Yeah. All right.
So it's a great
Well,
business. I mean, the returns,
yeah.
the free cash flow yield, these companies are, they're great companies. They have been for the last several years, not like they were in decades before where they destroyed capital. They are doing the right thing now. And you look at all the valuation metrics, and I think this is one of the best sectors out there. The only risk is that people say is a pullback in oil prices. But again, where a month or two ago they were worried about oil going back to 50, and you'd brought up, mentioned in a couple of calls, oh, could we go to 50, $55 a barrel? That's out the window. And so now I think they're like, oh, what happens if it pulls back to 65? And again, I think the new normal, once we get past all this noise here, if we can, U.S. can get control of the situation, is 70 to 75.
Yeah, I mean, if you wanted any kind of performance this year, I think what the market's down about 5% year to date. If you wanted any outperformance, you had to be in energy. So that was a great call.
Yeah,
I've
and
enjoyed it.
here, the important thing is, if investors on the call, they say, okay, fine, what do we do today? I'm holding on. I'm not adding to positions, but I'm not selling. I'm holding on to what I've got.
Mhm. Yeah. All right. Do you mind if I pick up from there?
Yeah, love to hear what you've got
Okay.
to say. Things are
Um,
rebounding here this morning. You've been great on the
so
bank stocks and J.P. Morgan, so I'm curious to hear what you say now. Is if the market feels a little relief, what do we do now?
yeah. So this weekend I wrote about the wealth effect, and this week, I mean, the big news that all eyes are going to be on the FOMC meeting. But a lesser known statistical release from the Fed is called the Z1, and that comes out on Thursday. And that Z1 release, which comes out quarterly, um, basically shows the balance sheets of governments, of the US government, of corporations, of nonprofit organizations, but more importantly, it shows the balance sheets of US households. And so I did some work in anticipation of the release this Thursday of the Z1 and tried to calculate and the wealth effect from stocks and housing. And Jen, if you can put up the first slide, this slide shows the household wealth of just those two components. There's a lot of obviously other components like fixed income. This is just looking at equities and real estate holdings. And you can see the pre-COVID period of 66 billion, um, you know, in 2019 has jumped to 118 billion today. So there's been over a $50 billion increase in household wealth just from stocks and from real estate. Um, in that same time frame, um, GDP has gone from like 21 trillion. I'm sorry, these are trillions, excuse me, trillions. GDP has gone from 21 trillion to 31 trillion plus in the fourth quarter. So that's a 10 trillion. So we've had a five-fold increase in wealth creation versus GDP growth. So it shows how important wealth creation has been to consumer spending and consumption and therefore GDP growth. Um, and I want to hammer that home because the wealth creation is very vulnerable to what's happening on home prices and what's happening on stocks. So let's take a look at one last statistic. So if you've got about let's use 120 trillion of household wealth to 32 trillion of GDP. that's a ratio of about 3.8 times of wealth to GDP. Prior to the great financial crisis of 2008, that ratio is about 3.0 times. And then prior to the bust of the dot-com bubble, that ratio is about 2.6 times. So you can see that wealth creation relative to GDP today is so much bigger and so much more important than it was prior to the GFC and the dot-com bust. So let's look at the components here to talk a little bit about that. So the next slide, Jen, if you can put up the next slide, is what's happened with stocks. You know, this is the market value of equities held by U.S. households, and you can see it's gone from about 34 trillion to about 67 trillion. So it's almost doubled over the last 6 years. And then equity, those are the blue bars, and then equity values as a percentage of total assets on household balance sheets have gone from around 25% to a little under 35%. So again, stocks have been a very important part of the wealth creation in household wealth. And you can see back in 22, when the Fed raised rates, we did have a dip in stock wealth. And that's what I'm anticipating, is that over the next year or two, we're going to see significant correction in equity values. And that's going to create a negative wealth effect for the consumer, particularly the high-end consumer, which is the cohort that's really propping up this economy with their spending. So let's go to the next slide. By the way, on stocks as a percentage of financial assets. So here, this orange line shows stocks as a percentage of total assets, but stocks strictly as a percentage of financial assets have gone from less than a third in 2019 to almost 50% in 2025. So it's just a huge increase in the wealth effect from stocks, that if we have any kind of correction, and importantly, that correction doesn't have the immediate bounce like we did in COVID, it's gonna slow down consumption. So let's go to the final slide, and I'll just talk very quickly about. Oh, I guess we don't have a final slide. Anyway, you'll see the same sort of thing in terms of commercial real estate. I mean, not commercial, residential real estate. Over the 6 years, residential real estate has gone up 1.6 fold. And so it's also had a wealth effect. Now, we've already started to see a softening in residential real estate values on household balance sheets. From the second quarter of 24 to today, the increase in residential real estate values on household balance sheets is up less than 1%. So that's over, a 6-quarter period. We've grown less than 1%. And we saw the peak back in the second quarter of 25, and it declined in the third quarter. And I think when we get the data this Thursday, you'll see another decline in real estate values on household balance sheets. So we're already starting to see a softening on the real estate side. I've been on record saying that I think there has to be a 15 to 25% correction in residential real estate values over time. This is a slow-moving asset that adjusts very glacially. So it's a multi-year process. But the bottom line is the combination of a correction, a material correction, obviously 20, 30% type of correction in equities, and the continued slow decline in real estate values, I think raises the probability that by the end of this year, we could be in a recession. So there are things that have to happen, obviously, because we're on equities, we're only down 5%, which is nothing. And on real estate, it's a glacial process. So there are things that do have to take place, but I think you have to start thinking about how markets and asset deflation can create a recession, because it's very different than the typical thinking that it has to come from higher unemployment or the Fed raising rates. I think this time around, it's going to be a deflation and a deleveraging and an unwinding of asset values, such as we're seeing already in private equity. That will create the recession in the future, not higher unemployment. That will come after the fact, or not higher rates. So that's my thesis, and I'm sticking with it.
Hey, Charlie, that wealth effect, from real estate and stocks, what percentage of that is concentrated in the wealthiest? In other words, that wealth effect is accrued to 15% of the population because that's who owns stocks and valuable real
Yeah.
estate. And so that was my first question. How concentrated is that wealth effect?
Yeah, the Z1 doesn't break it down by income cohorts, so I don't have an answer to that. It just shows a consolidated number. But I think it's something like, 20% of the population is accounting for 80%. It's that 80-20 rule, 80% of the spending now.
Right.
So it's that upper income that is going to feel the negative wealth effect if we have a correction in stocks and equities. And so that's what I'm watching is does that upper income, and so you're going to want to listen to what Ralph Lauren has to say, what Tapestry has to say, what Viking Cruise has to say, Ferragamo, all those high end consumers. And I think Berna has pointed out that in the first quarter or year end calls so far it's been pretty good. But on the housing front, Toll Brothers has started, their upper end housing, they have started to see the same margin pressure that the low end guys have seen. So there's starting to see some resistance. It just depends on what consumer product area you're looking at.
Yeah, I guess when I think about it, that 20% where the wealth effect is concentrated, the biggest risk to the market is that they've been holding stocks. In other words, I haven't been selling. For me, I'm not selling stocks. I've just spent based on what I think my income is. But if I think all of a sudden my wealth is going to drop sharply, that's where consumers come in and panic and say, "Well, I'm up 50% on stock XYZ, so now it's down 10%. I'm not going to write it all the way back down," and then that sort of feeds the momentum on the downside. If there is some event, some panic about a pullback in asset values of the stock market, I think that's what creates some of that fear and the downward momentum that you talk about. But for a recession, then I guess that high end has to say at some point, well, not only am I worried about my wealth going down, what I see on paper in my portfolio, but now I got to spend less because I don't feel as wealthy. Not that I was counting on selling stocks to be able to spend for my vacation. It's now you feel like your income or cash flow is at risk to the point where you slow down your spending, I guess. And
Yeah,
when is
the
that
Fed is
that pullback, that feeling of my wealth is going convert to okay, now I got to be more frugal in what I spend.
Yeah, that there are some studies done by the Fed that show that the wealth effect is overtaken disposable income as the primary influencer of consumer spending. Um,
Interesting.
so yeah, I do think, and the other thing is, we have this buy the dip mentality has worked beautifully for the last 5-6 years. Um, if you look at the Mag 7 stocks, it's not working anymore, the buy the dip. And you have to sort of wear those buyers down before you get that kind of correction that doesn't bounce back. And that's important. I mean, if we get the COVID type reaction where you get a 30% sell off and then we quickly come back by the end of the year, then the high end's not going to feel that negative wealth effect. And you have to wear down those buy the dip buyers first and have that correction stay down and just move sideways, where it's just tough to recoup your gains. I mean, recoup your losses. And I think that's the kind of market that, we risk going into 27 is that we get a correction, whether it's this spring or next fall, I don't know. I've been talking about a big correction, by April, May, June, where the Dow, I mean, the S&P is down 6,000 or so. To 6,000. But, I think there has to be a lack of a bounce to really make people feel less wealthy. So we'll see. But, the odds of a recession are climbing. There's no question about it. So we call it a morning, Bob, and thanks for joining us on Wall Street Beats. It's March 16th. And if you want to learn more about energy, Bob Morris is our expert. And if you want to learn more about financials, I'm happy to help. So
Yep.
please come
Stay,
join us
stay,
again
stay,
tomorrow.
stay tuned. It could change in a heartbeat. We'll see what happens, but we'll see how the
Yeah.
week goes. Everybody stay tuned. Thanks for joining. We'll see you.
Thank you. Bye.